Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Joanna Gallegos. She is from BondBloxx, and we really have a wonderful conversation because she has such a rich experience in the ETF space. She's launched 175 ETFs and counting. She's a co-founder of BondBloxx, and they have done an exceptional job in such a short period of time, getting that firm over $3 billion. So we focus on the ETF landscape, and then we move into one of their many products, which is XCCC, which is CCC rated US high yield corporate bond ETF. It's very targeted exposure in that particular tranche of fixed income. So I think you'll find the product compelling. But without further ado, please welcome Ms. Joanna Gallegos. Hey, Joanna, welcome to the show. So before we get started, let's talk about your background and how you eventually moved into co-founding BondBloxx.
Well, I've been in ETFs my entire career. I started out at Barclays Global Investors, the very early days of iShares. And then BlackRock acquired that firm. And really shortly after that, I moved on to JP Morgan. What I did in the first part of my career at iShares was I was in the product team, and I helped launch a lot of the inaugural products in equity and fixed income, specifically fixed income with the team I'm with now. And, I'd grown with the business a while, and then JP Morgan called and said, we're going to start a new business. And so I went over there to help them start their ETF business. And I was there for almost 10 years working on that. And then BondBloxx called. It wasn't BondBloxx then. It was a few of us that started the firm in October 2021 at the time. So a few of us got together. Our CEO, Leland Clemens, has been an architect of fixed income ETFs, both in terms of product design, but also in sort of how they lived and breathed in capital markets. It's really hard to appreciate right now, but when we launched HYG in 2007, there just wasn't the bond market infrastructure to match sort of the equity infrastructure that ETFs operated in. And so there's a lot of work that had to be done to connect all of those points, literally going to different desks at different big firms and explaining to them how to price, a bond portfolio of so many bonds and then how to get that working. So he was a really kind of early pioneer in that. He and another co-founder, Tony Kelly, and he always had this idea about focusing on fixed income and launching more product that would help, be easier to create portfolios with and be more precise. And COVID happened, and it was sort of, I would say, maybe the third major volatility event that affected all markets, but specifically fixed income markets. And he called another co-founder at BondBloxx, his name's Brian O'Donnell, and said, hey, we got to do this business. We've been talking about it at conferences over drinks for so long, but the way that markets have been functioning and the role of ETFs, specifically in fixed income, it's time. Like, do you want to do this? And so they made a couple more calls, and so there were 7 of us that came together in October of 2021 to form a fixed income only ETF provider. We saw a few things. One is we knew that rates were going to rise at some point. We knew the volatility would continue in the markets. And we also, because we both, in our former days together at iShares, but also in our subsequent roles at JP Morgan and Goldman Sachs and Northern Trust, knew that there wasn't enough fixed income product for the markets of the next 10 years, because we see that markets in the next 10 years were going to be very different from the markets of the last 10 years. And so we saw that there was a pretty fixed income product was underdeveloped for quite a long time in ETFs, and it needed to be focused on. And we wanted to bring more precision to fixed income investing through ETFs. And that's the premise of BondBloxx, is that clients need to have updated products for these markets because they're different than the markets that they were familiar with from post GFC and even before, and that there wasn't enough development focus on delivering that product to market. So they're about 80% of all ETFs are equities, and that's really surprising. So we saw a lot of future growth in fixed income and a lot of underserved clients, and that's me. Yeah.
Well, before we talk more about BondBloxx and some of the things, I always like to ask people, what do you like to do when you're not sitting behind the desk? And, what any hobbies, things you like to do for fun?
Like about this, I only have time to run after my 4-year-old and 5.5-year-old. And so my days are on New York City playgrounds, getting wet in the sprinklers for the summer, or, just from, Friday at about 4:00 until Sunday at about 9:00. That's what I have time for, is scheduling out their world. I try to be present at their school and volunteer in their school. And so, this, and I think many entrepreneurs on your show know this, your job doesn't really turn off, on the weekends. And so I have 2 commitments, and that's BondBloxx and my family. And I'm having fun, I'm doing lots of fun stuff with them. So that's what my hobby is. There's no me right now, and that's all right, because I'm having fun with my boys.
4 and 5 is a crazy age. I'm approaching, I've got one that's out of that stage. The other one is entering that stage. And it seems like every 5 seconds he's trying to do something that he's not capable of doing and is going to hurt himself. But
yeah, I've got a climber and a jumper, and I'm active on those playgrounds.
That's right.
I'm catching children.
Yeah. Yeah, right. So you have a really impressive background. I was reading your bio. You've got 175 launches. You also have some ETF related patents. Can you talk about those at all?
Yeah, sure. So I'm named inventor, and so is another co-founder of BondBloxx, Tony Kelly, on the multiple basket patent. So there was a wave of business process patents that people did with ETFs back in probably 2002 to 2004. And they're not particularly protective unless you pursue them. But, we kind of put a stake in the ground on the IP that we had built. Multiple baskets is used so prolifically in ETFs and is so relevant to fixed income that people may not want to know about this geeky detail, but essentially it's a way for, the standard baskets that, if you know the structure of ETFs, they trade in portfolios of securities, and they're called baskets. And so for an S&P 500 fund, you have 500 names in that basket. And if you deliver those securities to the provider, they will deliver you shares of the ETFs. And so if you want to alter that basket for a lot of really good reasons, you create a second basket. And so one is for creation and redemption, and one may be for just pricing the basket in a different way. And so that's what the first patent is how do you do that operationally? And nowadays, that process was actually codified in an SEC rule, like 6011. Again, getting super nerdy here. But we do have the patent on it, or we're named as inventors of the patent on it for having, developed that business process really, really early on in ETF history.
No, that's great.
And the second one was while I was at JP Morgan. I'm named inventor of a ETF portfolio management system and trading system. And so when I got to JP Morgan, we had to build out, technology infrastructure to, connect to all the portfolio desks and create these baskets and help portfolio managers run their funds every day. And so we built a piece of technology, and I and the technologists are named on that patent.
Oh, that's cool. We have ETFs.
They're kind of boring when you explain them. But
no, it's cool. I mean, but still, it's cool. Yeah. Anytime anybody's so deeply in the space and able to, make it more efficient or change it, I had to ask. So
yep, that's what it is.
You had made you've been in ETFs your entire career. Just curious on your perspective, like how has the landscape changed over all the years? And do you think there's room for further innovations in the space?
Oh, if the last 10 years has proven anything, that it's that the ETF industry needed to be innovated and needed more competition and needed more providers. So the landscape has largely changed from this dialogue about the big three providers in the marketplace to smaller providers and traditional active management firms coming in. And when I had some experience with this, and so did another co-founder at our firm as well. It's like when you bring ETF capability to an existing asset manager or a really large asset manager, they quickly find out like how interested their clients are in ETFs and how they've been using them. And maybe they hadn't been having that dialogue with clients, but now they have this new offering and way to talk to them. And importantly, that gives choice to investors in ETFs. And there is some fatigue, as I mentioned, like your innovation budget can't be as big if you're traditionally one of those older chassis ETF providers that are really big. Like they have multi-asset products, they have hundreds of products. Every incremental product that they want to maybe, to try out has a big margin to clear in order to get through the product development process. So, there's a lot of competing priorities at those firms, those large ETF firms, where when you bring in smaller firms like newer firms like BondBloxx or established, other asset managers that come in space, it just benefits investors because they have more choice. They have more product to interact with. They have more providers to interact with. And I think that has been really, really important. Then this really boring technical thing I just mentioned, but regulation leveled the competitive playing field for all ETF providers. That's incredibly helpful to the landscape going forward. Like I said, the next 10 years are going to be very different from the last 10 years because just not on purpose, but the SEC just invariably were giving like different types of, rule sets to different providers along the way over 20 years. And they normalized all that and made it so that everybody plays by the same rule set. So competitively, that's fantastic. And I think you see that in the choice of product, maybe yours as well. It's like, there are a lot of registered investment advisors that are bringing their expertise to ETF to clients. There's, I think there's some interesting strategies that are out there that, haven't been there. So more choice, more ideas, tons of innovation and focus. So BondBloxx it's important that some of these firms like BondBloxx, like they're focusing on a problem and they're investing in that problem every day. And they're solving things for clients. They're listening closer to clients of what they need. And that's good for clients. It's good for people.
So yeah, no, I couldn't agree more. And you're seeing, which kind of leads me to my next question, like RIAs, active managers, or people who are kind of traditionally running SMA portfolios or moving into this ETF space. You and I have the misfortune of both being the chairs of our trust. It comes with extra work, but can you talk to me about the decision, like why BondBloxx decided, hey, we want our own trust rather than just white labeling it like it seems like most people are doing these days?
BondBloxx is a team of deep ETF experts across Vanguard and State Street and BlackRock and JP Morgan and Goldman Sachs and Bloomberg. And there's just sort of we know how to get these decisions made and to get them done faster. So we can execute better if we grew everything from scratch. So I think, not uniquely, but we had the capability to do this. Like we could do this. I think going to a white label is you're buying the capability in someone else, and that's appropriate. I think that works for getting to market quickly and simplifying a ton of things that you don't need to do. It's really in the innovation decision making we want to be able to make, and also just the execution timing we want. That's why we did it. We know how to do it. We're really good at doing it, and we're really great at executing. So we stood up our business. We all came together. We assembled in October of 2021 in the same place. And we had our first fund launched in February of 2022. So we stood up the asset manager. We stood up all of the infrastructure to run the trust in 4 months. That's really hard to do if you don't go to white label. But that's
Right.
why.
Yeah. I mean,
There's no reason to go pay someone to do it. We can do it
do it
ourselves.
yourselves. Yeah. I
Yeah.
mean, we had a similar thought, only congratulations on 4 months. It took us 7, but that's okay.
So great. Yeah. Good.
So kind of staying on you for a moment and even maybe the rest of the team, right? You guys all came from well-established places. You were at bigger firms running really large ETF books. How has the actual experience been for you as kind of a co-founder and an owner rather than working for, a bigger, larger corporation, like at iShares or JP Morgan?
Very specific opportunity. I was so happy at JP Morgan. And I talk about JP Morgan a lot because it was a place of innovation for me and growth. And I was supported there and I loved my team. But this team, this particular group of people, it was sort of a dream job where I had been working with them not very recently, probably hadn't worked with any of these individuals for 10 years, but I've known them for 24 and I know their work and I know we had a shorthand and a trust that like snapped up very quickly. And to me, that's just an amazing way to work. I've never felt like I could, really work exactly the way I wanted to work. And that's what this group is. And so what it feels like when I'm at BondBloxx is I'm working with the people I want to work with. I'm working on the problem I want to work on. And I'm doing it with a group of it's not just the people we start off with. We're almost 30 people, but I'm doing it with a team that is really, really motivated to get this right. And it feels great every day. So that's what I think people would assume BondBloxx would be like, going from the big firm to the little firm. The other thing that's just I'm so appreciative of that we have a ton of perspective and a ton of context from leaving a bigger firm and acquiring, you probably feel this way too, like acquiring every single client and being so humbled and, and feeling so appreciative that like clients are choosing you so quickly. That's been great. Like relearning sort of the path to engaging with a client, earning their trust, having them buy your product early. It has this just great virtuous cycle of it feels great. It feels great to do something super, super hard. It is hard. The perspective of being away from a bigger firm is it's harder. And the people at BondBloxx signed up for that degree of difficulty. Our first hire was in March of 2022. He came from Bloomberg and he called us and he said, I know what you guys are doing and I want to do it too. And that's not the only call we got. 2 or 3 months later, we got a call from Joanna Gallegos, who is our market strategist here at BondBloxx. And she said, I saw you guys on TV and I wanted to be part of that. So like everyone's sort of self-selected into this degree of difficulty. And that's an incredible team to work with. It's harder in a lot of ways, but it has an energy that keeps you really focused.
Yeah. Well, it has an energy and there's a certain certainness to it where, it's hard every day, but you're kind of all working towards a common goal together and you're all in it together and it makes it more fun. You mentioned, those little wins and you guys have had many little wins because the entire suite is now have grown over $2 billion. If I don't know where it is today, but that was the last ADV I saw. You can't.
Brilliant.
Okay. Well, big wins and you've done it really, really quickly. And so first, congratulations on that success. I mean, starting the firm in 2021 to getting to 3 billion this fast is exceptional. So first of all, congratulations. But kind of what do you attribute that to and how did you guys go in viewing the strategy around marketing and getting that distribution so fast?
Well, one thing we had an advantage of is that we get to use all of the tools of today to establish our brand and build our brand. So we started on making our entry point into the market, as loud as possible. So we started with PR and we talked a lot about like why we were coming to the marketplace. I think it was noted to your point, like some of the initial employees of BondBloxx had resumes, like you generously complimented my resume, like we have these really deep resumes and all of us in one place, was the first sort of like, wow, what's going on over there and what are they doing? And then from there, we started to build the brand bit by bit. And also, I think we benefited from the fact that in February of 2022, markets completely changed. I mean, we thought interest rates would rise and we thought there'd be higher volatility over time, but we didn't think it would happen so fast, and it happened really quickly. So fixed income came into view. And right when we launched, we had a lot of opportunities in PR to tell our story and to get out there. And then, we have an amazing CMO at BondBloxx that has, built our brand brick by brick. So I think that we've made a really great impression and we've been able to reach a lot of people quickly. That's a huge key to our success. People have heard of us. I'm so excited when I say, oh, I work at BondBloxx, or I have the best one is like back to the playground. I wear my BondBloxx baseball hat on the playground. I'm pushing a swing with my kid, and someone's like, "Oh, I know BondBloxx," and they want to talk to me about BondBloxx. Like that's a big testament to getting your name out there. And we punch above our weight. That's what we like to say at BondBloxx in a lot of ways. And in brand, I think we do that with clients. Listen, like we also know what to do there too. We hired some of best and most experienced ETF salespeople in the industry, and they knew who to call day one. And they knew how to call those people back day 2 and day 90 and day 120 until they came into the funds. And so again, it's that know-how and that initial plan. I think though, what you have to be appreciative of is like what works in the first year or two isn't going to work in the second year and the third year and 4 years. So the degree of difficulty is always leveling up. We're in that space right now. Like 3 billion is great, but what are we doing to position and talk to clients about what's going on in rates and what's going on in credit right now? How do we make sure we're getting our share of that big migratory transition, that big migratory sort of move from assets from, risk-free assets into credit? Like we have to be on top of that as well. So again, it's a know-how. It's really leaning into brand and digital ways to amplify what we're doing. And we're just out there, Brad. Like,
Yeah. It's funny you mentioned the hat.
Be out there every single day, all across the country, and that's what it takes.
It's funny you mentioned the hat. I do the same thing. I make fun of myself sometimes if I kind of look like a race car driver at times with the brand on, but it's something you got to do.
Everybody's wearing their BondBloxx fleeces or all weekend. Our spouses, our spouses are wearing it. Like this is all a family affair, BondBloxx. So
well, what makes it what I get a chuckle of is, so I bought when we launched our first ETF, I bought a box of 100 hats, and people would notice it, and then like friends and family started wearing them, and then like people who were around in our neighborhood like wanted them, and so we go to the pool on the weekends. There'll be 7 and 8 year olds wearing our THOR hats around, and it's like I love it. I love to see it. I'm like, you guys are now my favorite. So whatever you want.
If you see me in an airport, I've got a BondBloxx backpack on, a BondBloxx hat. Like it's also because I love the hat. Like I love wearing it. And my husband and I fight over one of them and I keep them away from my kids. Like I'm like, don't touch my BondBloxx stuff. Like
the problem is now I have too many hats. And I've got to get rid of some. But anyways, let's talk about some product. You've got
product.
XCCC.
Yeah.
It is your CCC rated US high yield corporate bond ETF. Mm-hmm. At a high level, can you just help me understand, what the product is and what it's trying to accomplish?
Yeah, so I will back up and say that it's part of a larger suite of solutions. So what BondBloxx's entire product line is about is precision and fixed income. And so we started in high yield back in 2022, and it wasn't sort of the thing that people really wanted to talk about at the time. But what we've known from 20 years of fixed income ETFs is that everything started in big blunt blocks of broad market exposure. And this just hadn't been updated yet. So in high yield, we brought forward 2 things. We brought sector products. So we brought 7 industry sector products in high yield. And then we did 3 credit rating products. And so trading through the credit spectrum in credit in general, but in high yield specifically from BB all the way to CCC is actually how institutional investors think about their portfolios and where their risk is. And so we wanted to put all of these tools. There's 10 different high yield ETFs that we have. There's actually 11 because we have a sector rotation product as well. But there's 10 different ways that you could amplify your exposure in, your broad high yield exposure. And so XCCC, the reason I thought it'd be a good place to start is two reasons. One is it has had an incredible story in the last 2 years. And two is that, right now, as we're thinking about rates declining and the resiliency of the economy, even within today's news of, seeing some softening, XCCC is sort of positioned really well to, provide extra yields, lower volatility versus equities. It's a great opportunity. It's our top pick in the fixed income opportunities right now. But what it is essentially is it's a diversified portfolio of over 220 bonds in the CCC category. And to orient you on why that's different and new is that, when you think about a broad-based high-yield product, or you think about benchmarks in high yield, like, the bigger index, broad high-yield products, there's about 10 to 11% at any given time of a broad high yield benchmark in CCCs. So if you're buying a high yield ETF today and you're getting the beta index exposure to that, you're already exposed to about 10% of CCCs. And so what is interesting is, for someone that's using that in their allocation today, this is a really great complement to say, well, maybe you should be adding another slice of CCCs, adding more exposure into your broad-based high-yield exposure. The yield has been bouncing around 12% all year, and it's had some amazing price appreciation in 2023. It should have good price appreciation going forward, given that rates are coming down. And, you can be enjoying, a really big yield pickup by, adding some CCC to your portfolio. So that's one way to think about the product. The advantage is that, you're getting the benefits of diversification. So a lot of active managers in fixed income or in high yield, they're picking CUSIP by CUSIP, right? They're picking a set of CUSIPs they think are the right CUSIPs to invest in. And often a lot of high yield managers just exclude CCC altogether. And so whether you're picking a few CUSIPs, you might be unintentionally underallocated to the category versus your benchmark. So you could add this to sort of get you at least benchmark neutral, but still express your views through those individual CUSIPs. So that's another way I think it complements an investment process. Or if you're out of CCC and you want to be out of CCC, it's a way to use this really efficient product or the other products actually. So you would use double B and single B to build your portfolio. So if you want to lean into the higher quality side of high yield, you do that. So these credit rating products and these sector products are all designed so that you can express a view and a more precise view, lean into things as they're happening. So you have the benefit of the liquidity of the ETF to get in and out of these positions. You have the benefit of them being diversified portfolios. You're not buying one or two bonds in CCC, which is risky. You're buying hundreds of bonds. And it hasn't been done before. And it's really impressive how effective the pricing is when you're trading it on exchange. And that's CCC. I think it's a broader story about the whole product set at BondBloxx and how you use them. But I like CCC because it's our top pick in terms of an opportunity in fixed income, and it's really has a ton of utility for these markets.
Well, when an advisor looks at, say, CCC, the first thing that comes into their brain is going to be that two words of junk bond. So
yeah.
What can you explain?
Yeah.
What's that?
Thank you, 1980s. Yes.
Yeah. So let's clear the air then. Can you explain, I guess, what do investors get wrong about this tranche of fixed income? And, why is there value in looking at this tranche?
Well, I think what they're getting wrong today in this market cycle is they're getting wrong that the fundamentals of high yield in general are very, very strong. they're also getting wrong that we're not in a credit downturn like we've seen in other market cycles. So you've had a resilient economy, especially, and the high yield fundamentals have held up. And, you actually sort of, when you look at the broader market, there's actually an up in quality in high yield in general. So there's a higher percentage of double Bs in high yield issuance. And, that means that like the category itself has a much lower default rate. And it's been that way for a while. And so, yes, if you go all the way down into the credit spectrum of triple Cs, there's a higher default risk, but you're in a portfolio of hundreds of triple Cs. So that is dampened and offset a bit in the diversification. And we're not past historical norms for defaults. And so I guess what people are getting wrong today is we don't foresee an economic event that's going to impact this category in triple C any differently than, it would normally. And that means you get the benefits of all of this exposure and you get the benefits of this yield in one trade. And so that's where I think, we've been talking about triple Cs for 2 years, and people have been asking us about like something, something's going to happen. People won't be able to cover their interest because rates are so high. Well, this category also, which is different, this market cycle is different because it started off with the pandemic, and a lot of these issuers refinanced their debt at ultra low rates, and so they're in a really good position to pay their debt, and they've weathered these higher rates pretty well. There's also a sense that like as rates might be coming down in the next couple quarters, the maturity of some of this debt, again, most of it being higher quality in the broader category, the maturity of this broader debt is going to happen in 2025 and 2026. That's a lot of time, to absorb, refinancing rates and to weather this storm. And I think it's been working really well. So what people have unfortunately missed out on is if they haven't invested in the category, they've missed out on the yield. In 2023, it was the top performing category in fixed income. It returned over 20%. And, it's hard for people to create a relative sense of what's different about junk bonds. And I try not to use that word today versus what they knew and what they're associating. They're associating with like the floor dropping out and everything going away. That can happen if you build up really specific idiosyncratic risk in your portfolio with certain CUSIPs and certain fundamental, in certain smaller size exposure to triple C. That's not this product. Right. This is category exposure.
So as you mentioned, there's hundreds of different CUSIPs in here. It tracks the ICE Triple C index. How just quickly, how often is that index reconstituted, and how often are you kind of rebalancing the underlying?
Every month, yeah. Every month it's rebalanced to an index.
Yeah, and so you also mentioned, this particular product has really juicy yields. So how susceptible is NAV? And we've talked about it a little bit, but Fed lowering interest rates, potentially, I wouldn't see why they wouldn't now. But, I guess my question is, what's the relative volatility of this product maybe compared to some of the more broad-based benchmark high yield exposure products?
It's going to be, it's going to be a little higher than the broad-based high yield. Broad-based high yield is closer to equity than other categories in fixed income are in terms of its volatility. I think the thing you want to, there's two views that we have at BondBloxx. One is we don't foresee an immediate recession coming. Although, I think people are really reacting every millisecond to every economic piece of data that comes out. You need to see some trends. And I think that has been true of this whole period where a lot is made of one economic indicator. People have put trades on and been very wrong in many different points of this journey. So you need to see more, but we don't foresee a recession coming. And the second thing is that, again, going back to bond math and just giving some historical perspective on this, like the coupon income has been the primary driver of long-term returns in fixed income and specifically in high yield. We have some data that shows that it really has driven and absorbed volatility in the high yield segment. So in particular, when you have a 12% yield within the portfolio, it can weather price volatility very, very well. And so that did happen in 2023. The yield was high. There was some volatility in the underlying, but the total return, because of the coupon yield, was cushioning that along the way. So that's what's really important. And so the second thing we believe is that rates are going to be higher for longer. There's a lot of estimation that rates are going to really start to turn around after September. And I think there's one firm that's calling for 8 rate cuts successively, like very quickly. We don't see that happening because, again, there's economic targets that haven't been met. So you need to see that all come together. And I think that supports our view that rates are going to be higher for longer. There isn't an impending recession. And that backdrop I gave you, which is like, this is not the credit market everybody wants it to be. They want it to be like much more of a downturn than it has never produced itself to be. So to your question about like volatility, like, yes, it is more volatile than the broader high yield, and it has higher volatility than other classes, but it's been supported by this gigantic coupon. And that has been, I think people just forget that's how bonds work, and that's the benefit of higher rates.
So when talking to an investment advisor, most of those investment advisors are, when they think of high yield, they're going to, and probably a product that you worked on, HYG, right? It's a $16 billion behemoth. I will say your expense ratio is lower, your yields are higher, and the performance has been better. But if you were to kind of sit with a registered investment advisor, how would you allocate to XCCC? Do you view it as a complement to your overall high yield basket? Do you view it as a replacement? Like, how would you make that recommendation?
We take everything out and go put it in Triple C. It's like adding a slice of it to your high yield. I think that there's been a lot of flows into credit ETFs, both on the corporate side and on the high yield side. Specifically in the last 3 months, flows have picked up. So I think, they've been pretty strong actually since November of 2023. But if we're seeing that investors are willing to take some risk, they're willing to go back into risk assets, here's a way to optimize that viewpoint and, and like I said, just add a little bit more into that space. So in Triple C, what we would do is it's a complete complement. And it's just, your viewpoint on here would be that, like, you don't see recession coming. You see rates dropping. There's a price appreciation opportunity here with Triple C, and there's a volatility absorption with such a high coupon. So lean into it more, because your typical exposure, like I said, is 10%. Lean into it more. It could be a source of extra performance and extra yield. And you couldn't do that before. You couldn't trade 200, Triple C high yield bonds on exchange before, and you should be able to. You could also feel a little differently, and you could go a little higher in credit quality and add more single B. Single B has a really great sweet spot in credit in terms of the risk reward there, and that's what those credit rating products are meant to do, like express your view and be able to move in and out of your view as things develop.
Well, Joanna, this has been really wonderful. Before I let you go, where can people learn more about your entire suite of BondBloxx products, including XCCC, and also learn more about you?
About everybody at BondBloxx. And I would love people to take a look at everyone who is making this firm happen. So we're at BondBloxxETF.com, and there's a lot of information on there. We just released our mid-year outlook for 2024, and it has some really cool detail on what I've been speaking about, especially about also on treasuries and rates right now and our viewpoint there. So a lot more to explore with BondBloxx on that site.
Well, again, thank you very much. I'll keep my eyes peeled in the airport for that BondBloxx backpack and hat or at conferences. But again, thanks for spending some time with me.
All right. Thank you so much, Brad.